Folks, we have spent a lot of time working with Anna Kelly talking about commercial real estate, Fed put, the economy. I want to step back and talk about residential real estate. So we're talking houses mainly, maybe up to fourplexes, stuff that is financed with 30-year fixed rate debt most of the time. We're going to talk about where we see pain and maybe some opportunity. Anna, how you doing?
I'm doing great. Always so good to be here with you, especially on Fed Day.
Fed day, Fed day, Fed day. Absolutely. So I am one that thinks housing prices are going to be flat and boring for the next 3, 4, 5 years. I think transactions are going below 4 million. And let me tell you, my audience really gets lit up because everybody wants to see a price crash a la 2008, 9, and 10. I think
Yes.
there are some areas that are ripe for pain. So what are some of
Yes.
those areas that are ripe for pain and maybe some opportunity?
Great. Yeah, I generally feel that based on data, feelings aside, although I use that word loosely, when you look at data and the history of housing prices, like you and I've done in your spreadsheet multiple times on this show, going back to 1970, maybe
Correct.
1972,
1970. 70.
we can see that generally, even though there might be some small periods of big run-ups in prices and then kind of some big falls, generally speaking, it's like slow and steady runs the race, and it's about a 1% inflation adjusted rise in home prices per year over
Exactly.
all of these decades. And there could be greater wealth than that because of leverage and things like that. But just general home prices across single family across the United States go up in value about 1% higher than inflation every year. So when you look at that picture, let's talk about long term versus the next couple of years.
Mhm.
Over the long term, as long as people keep having kids or we
Yeah.
allow immigration and population rises, we're going to need more homes. And so there's going to be more demand for housing. And as unless we can keep up with the demand for that with low construction costs, which we don't have today, supply may struggle to keep up with demand. And when you have constrained supply and high demand, that bodes well for prices going up over time. Okay.
Sure.
Over time, some people take the completely contrarian view to that and say we have less and less and less population over the next 10, 20, 30 years, and therefore we will be oversupplied in certain areas and prices could come down. And so that is possible decades down the road, again, barring people start having more kids and we have immigration. So it's really, really tough to say where will housing prices be in 30 or 40 years from now. We're going to be pretty old, by then. So I'm not too worried about that far ahead. When you look at over the next couple of years, I think there's a couple of things, and you and I have said this on the show, despite many others that really disagree with us, that for the most part across the country, we are not going to have a major housing crash, not in terms of values. And the reason for that is quite simple, at least for right now, is that we do not have nearly the supply to spark a huge downturn in prices. While the Fed has pulled rates up, and that definitely is slowing demand, we see that transactions are in a housing recession. Transactions alone are very, very low because, quite frankly, today's values that are still peak values in most places, along with the highest rates, create one of the most unaffordable times in history to own a single family home. So
Yep.
that's making buyers kind of pull out of the market. Normally, lack of buyers would make prices fall, but we have a lack of supply created by the same Fed problem. And we've talked about this many times, but essentially the average homeowner, I think 80% plus of home loans are below 3.6%. Some of them way below that, even in the 2 to 3% range. And so there's no reason that most people would sell their home and add supply to the system, because if they did, they're going to have to pay more money just to rent a place today or to downsize. And therefore, that keeps people stuck in their homes. And that keeps us from having the massive supply increase that's needed to create that dynamic where lots of sellers want to sell, there's not enough buyers, and therefore they have to lower price. So as a whole, that is still my thesis, and it's held true since the beginning of time tracking single family values, at least in my lifetime. With that said, we always say on the show as well, and I know I bang this drum all the time, but Michael, housing is local, but Michael,
Yes.
real estate is local, it's
Yep.
regional.
Yep.
Because every area of the country is almost like its own market. And so if you compare areas, and again, I'm going to pick on California, not Fresno, but let's talk about like San Francisco or other, the LA area. Generally speaking, a lot of people are leaving
Yeah.
California and these high cost areas that have, increasing crime, raising their taxes and softening, employment in some areas. And so people are leaving those areas. So you have people that are moving, which increases supply, and you have lack of demand because of affordability issues. Those areas of the country tend to go up in value faster and they come down in value faster. And so we're already seeing pain in cities like Los Angeles, like Seattle, like Austin, even though that was kind of a place where a lot of people moved, certain places in New York and Massachusetts. So some of these areas where people are leaving, there is an increase of supply and there is low demand. And so values are falling and I think have further to fall.
Sure.
Other areas of the country, though, people are still moving, jobs are still coming, and there isn't enough housing demand. And so in that area, single family house prices are going to continue to go up. And we're still seeing those prices rise despite significant demand because the supply is just not there. So I think that you have to look at your market, know your market, do the work, like you always say. Look at your market and what's happening in your market. Now, if we talk about outside of regional variances, which to me, Michael, is the most important thing, where your property is located and its local economy and its employer base and its tenant pool and the strength of the consumer there, supply and demand, crime, legislation, all of those things make a big difference in the quality of that community and who wants to live there and who wants to leave. So where you're invested is the most important thing. The second thing, though, is asset class. So we're talking single family home, but within that, one of the things that I'm watching that I don't hear very many talking about is how is that single family home being used today? Is the single family home being used by a homeowner? Is the single family home a build to rent owned by a hedge fund in a neighborhood that's owned by a hedge fund? Or is the single family home a short term rental that was bought up in the last couple of years and being held reliant upon the income? Where I see the biggest potential pain, but also the biggest potential opportunity is in the latter two areas. So people that only talk about, housing demand for people that are living in it, they're missing the piece that other people are really warning maybe overboard, overkill. There's a housing crash coming. They're pointing only to Airbnb and these build to rent communities that are empty or that are held by investors who might have to sell. So I do think that in areas, in neighborhoods that were built by a fund, by Zillow Houses or Redfin or Open Door, for example, they're now having to sell some of these houses. I think that when there's a lot of supply because it's one big owner that's now dumping that supply, then in that area, those neighborhoods prices are going to fall. So if you own
let
a
me ask you
home,
about that.
your equity could be wiped out. But if you want to buy, it's a
Yeah.
good place to potentially buy.
Yeah, so I want to ask about that because I see that there's a lot of builders. We obviously know Billionaire Barry, who I pick on all the time. He just sold 2,000 homes. I think they were kind of spread out around the South, but he did. He sold 2,000 homes. What do you think this large home tract will be sold to individual homeowners, or like in Billionaire Barry's case, he found some other hedge fund and they bought them all at one time? Do you think it's
Yes,
one transaction or thousands?
I think they try first to go to the hedge fund. And I
Okay.
know this. I mean, I've read some articles about this. I don't know if you remember, but I bought a house, a single family house from Lennar
I
last
do.
December in
Yep.
Texas. And it was they built some build to rent and build to sell. But they had overbuilt spec homes. And so first they went to some funds and said, we want you to buy, 1,000 houses or 2,000
Okay.
houses. And they would sell them to those funds at a discount in
Sure.
bulk. But a lot of funds have said, wait a second, we're looking at these same supply and demand fundamentals, and we think that there's some risk there if
Okay.
rates stay high. And if we want to sell them and there's a lack of demand and there's too much supply, then we might be the ones holding the bag. And some of that trading to other funds has slowed down this year. And so
Okay.
I think when that happens, then they say, are we going to keep them as build for rent? Are we going to rent them out? Do we have the renter pool? And they might be better off not selling them at this point. They might be better off just renting them if they have enough people that can rent them. And there may be more renters if rates stay higher for
Yeah.
longer. So they've got multiple exit strategies. But
Okay.
if they decide to sell them and they try to sell 10 houses in a neighborhood at once, forget 1,000. Let's say you're
10.
selling 10 houses in a neighborhood at once, and I want to go sell my house because I need to move. I'm one of these people that has to sell. I have a job location, a relocation, or a death or a divorce. If I need to sell my house for 200, but this fund has now dropped their prices to 190, I can't sell my house for 200. Every
No.
buyer's got 10 other houses they could look at. So in those types of neighborhoods, that's really what could cause some prices to come down, is just an increase in supply in that neighborhood relative to the rest of the country. And so similarly with Airbnb, one thing I'm watching, Michael, and as you know, I have 6 luxury short-term rentals and I have 6 in my apartments that are short-term, midterm rentals. So I don't have a huge number of them, but I have enough that I've been doing it for several years.
You're interested.
I'm interested. And I
Yeah.
bought them in different periods of time. And I can tell you that the market and the conditions upon which I made investment decisions 2 years ago have substantially changed today. And so there are a couple properties that I'm actually selling right now that I thought I would hold a lot longer. And it's not, the good thing is I don't have to sell. I'm in a position where I don't have to be. And if we have enough buyers that are in a position that they don't have to sell, you may see an increase of inventory, but it doesn't necessarily mean that that inventory is going to have huge price cuts. They might just hold them and say, let's see if we can get ahead of maybe an increase in supply and cut our losses, take our equity, and wait for things to potentially get worse. But what I do see, and where I'm seeing pain now, and I think that there's going to be more pain and more opportunity, is areas that were oversupplied. And you're going to be shocked when I say this, Michael, because I was tooting the horn of this market when I bought a property there 2 years ago. One of them is the Sevierville, Tennessee area, Gatlinburg, Pigeon Forge, Sevierville. Okay, but we have similar markets to it in Austin, areas of Dallas, areas of New York. I mean, they're all over the country. And what you see is, as you and I warned about this, even when I was buying properties, I warned people, if a correction comes, or if there's too much supply at any one time, or people quit traveling, that was our big thought, is people might quit traveling if we have another pandemic, if we have a recession. We weren't thinking about sky high, inflation at the time, but for whatever reason, if people decide to slow down their traveling, your incomes are going to be hit. So when you buy an income producing property, whether it's a residential single family home, a short-term rental, a commercial real estate property, you're basically making assumptions about the incomes that you can generate, and then deciding, after you factor in your time and your expenses, how much income's left to cover the debt. And after the debt payment, how much are you left with for income? Well, here's the reality. The good news is most of us that bought properties were able to get really low historic rates that we might never see again. And so if you can afford to hold your properties even through a year or two of lower than projected incomes, even if you have to go negative, if you can hold on to those properties, then once rates come back down and things, supply normalizes and people travel again, if they continue to do so the way they did, then over the long term, and we advocate long-term investing, an investment can do very, very well. But in the short term, what we're seeing is that many short-term rental operator investors did not listen to us, Michael. And they said, you know what? Last year, this property or one like it did 100,000 a year. So I'm now going to build one, and I'm going to make it even nicer and more expensive and put an indoor pool in it, because then I'm going to be able to get 120,000 a year instead of 100. And they built $1 million plus cabins that are 20 minutes up in the mountain that people have to get to, away from everything. And now all of a sudden there's oversupply of the $1 million pool cabins in Sevierville, Tennessee. Well, people that have a lot of money, there aren't enough of them to come in and rent all of these $1 million cabins for, $4,000, $5,000 a week. And unfortunately, a lot of these investors that built them can't afford to cover the debt payment. unless they're making that $140,000 a year plus. Now that they're not, there's panic. And so there's a huge increase in supply in the Smoky Mountains. Similarly, in Sarasota, Florida, where beachfront property is great. People are still going to travel and go to the beach, but are they going to go travel and stay in a residential neighborhood 20 minutes away from the beach? No. And people bought in neighborhoods that weren't right by the attractions, thinking it was close enough. And if they build it, they will come. And so you're having big waves of supply of furnished short-term rentals hit the market, that all need to sell, that aren't generating enough income. And unfortunately, when a buyer like me or you, Michael, says, what's the cash flow that you've made this year? And does it cover the debt? It doesn't cover their debt, but it certainly doesn't cover mine if I'm now investing at 8%.
Yeah, 8.
So in order for me to make that deal cash flow, I have to get a huge discount on the price, even to break even and hope that I can refi later at a lower price. And that's going to cause values to come down substantially in those markets as supply continues to come down, as the owners start to have the reality that the number and the income I banked on from 2020 and 2021 isn't there in 2023, and it probably won't be there in 2024 and 2025.
Yeah. I am so glad we have receipts. This is areas that I was warning. Every time people think it's easy, real estate investing is never easy.
Right.
If you think it's easy and you chase easy, you're going to get in trouble. Anna, I got to run. Where can people find you?
You can find me here every week. You can find me at social media, Anna Kelly, REI Mom, and my new website, AnnaKellyInvesting.com.
That is awesome. Thank you so much.